Good afternoon, everybody, and welcome to Student Loan Forgiveness in Focus. This is a two-part series brought to you by the National Conference of State Legislatures in collaboration with the Pew Charitable Trust and the U.S. Department of Education. We know that student loans have been a major topic of conversations for the past few years, and the reason is that there's nearly 45 million Americans who have student loans. It's nearly 1/6 of the American population, and they owe nearly $1.8 trillion, which makes student loans the second largest form of consumer debt behind mortgages. Given the ever-growing student loan balance, the idea of student loan forgiveness has become a hotly debated topic in national policy conversations. Now, a lot of this conversation centers around whether or not the president or Congress should offer relief to borrowers to cancel a portion or all of student loan balances. But that debate is only part of the story on student loan forgiveness. In fact, there's actually a number of avenues already in play that allow borrowers to have their balances forgiven if they meet certain qualifications. So over the next 2 weeks, we're going to explore all aspects of student loan forgiveness. Today, we're joined by experts from the Pew Charitable Trust to talk about the most likely way that borrowers could have their balances forgiven, and that's through income-driven repayment plans. Next week, we're going to be joined by senior officials from the U.S. Department of Education to discuss public service loan forgiveness waivers that are currently available through October 31st of this year. Now, we also hope to hear from them on recent actions the department has taken to forgive student debt through a number of different avenues, and maybe get updates on anticipated actions that may take place from the department over the next 3 weeks. This is a particularly relevant time to be talking about student loans and loan forgiveness. As you may be aware, student loan payments have been on pause since March of 2020, but that pause is set to expire in 2 weeks on August 31st. Now, we still haven't received word yet on whether those payments will actually resume or if the pause will be extended yet again. Apparently, according to reports, August 31st is also the self-imposed deadline that the Biden administration has set to make a decision on whether or not to enact broad-based loan forgiveness through executive action. It's widely thought that the decision to resume payments and forgive debt will happen concurrently, so we have a lot to watch for, and we'll be sure to keep you updated on any developments, and we may have the opportunity to hear directly from the department if these developments take place in the next week. So before we dive into our conversation today, I want to take a little bit of time to kind of talk about how we got here with student loans and provide a brief overview of the major student loan actions that have taken place since the start of the pandemic. So as I kind of mentioned earlier, we know that student loan debt has grown tremendously over the last 15 years. And just 2007, aggregate national debt in student loans was about $516 billion, and that has grown steadily over the last 15 years. It's now nearing $1.8 trillion. About $1.6 trillion of that is federally held. Now, what's interesting is that even though the balances have increased year over year, borrowing in aggregate has actually decreased over the past decade. You see, looking at 40 or 30-year trends, this is data from Pew, that in 1990, there was about $20 billion in loans that were dispersed by the federal government. But that disbursement annually rose pretty steadily over the next couple of decades and peaked in 2011 when about $126 billion in loans were dispersed by the federal government. But since that high point, we've seen year-over-year declines in the amount of loans that are extended by the U.S. Department of Education. In fact, in 2021, annual borrowing was about $80 billion a year. Now, that's still very substantial, but it is less than we'd seen before. But that was sort of the trends moving up into the pandemic. And during the pandemic, there has been a lot of new developments within the student loan program. As we noted, there's been the student loan payment pause. Now, this started in March of 2020 and has been ongoing for this entire time. It's now about 2.5 years old. And during this time, borrowers have not had to make payments on their student loans. They have not seen interest accrue on those loans, and the department has not engaged in any collection activities. What's also interesting is that every month that borrowers are in the pause still counts towards any qualifications they may need to meet for public service loan forgiveness and income-driven repayment. We'll talk about that a little bit more later. Now, this loan pause has been pretty costly. It's estimated to cost about $5 billion a month. That's more than the federal government gives out in Pell Grants per month. The total cost through about May of this year was estimated to be somewhere around $110 billion. And at the time, the average benefits to borrowers for this payment pause tended to be about $4,000. And of course, we've got another 3 months of costs adding on to that. So this has been a pretty costly program. But what's interesting is that during this pause, the U.S. Department of Education during the Biden administration has also been very active on exercising existing loan forgiveness authority. So This slide is kind of an overview of the conversation that we're going to be having over the next couple of weeks in terms of loan forgiveness. There are actually a lot of different ways that student loans can be forgiven, and we want to dive into each of those for you all. The first one, which is what we're going to talk about today, I think the most likely avenue is through income-driven repayment. We'll talk about that in great depth here in just a minute. And then next week, we're hoping to have the department on to talk about these next three loan forgiveness options: the public service loan forgiveness, which I want to note that since the Biden administration, there's been about $10 billion that's been forgiven through the public service loan forgiveness pathway. In fact, actually, there's about $130 billion in student loans that are estimated in that public service loan forgiveness pipeline right now. So there's a continued expectation that even more money will be forgiven through this program. The Biden administration has also been pretty aggressive on forgiving student debt through the Borrower Defense to Repayment program. This is a program where students are, if they are able to make successful claims that they were defrauded by their institution or received misrepresented claims about the education they were signing up for, or if they attended an institution that closed while they were attending, they're able to seek restitution from the federal government. And so far, the Biden administration has forgiven over $13 billion in debt through this pathway. Back just this week, they forgave $4 billion in loans for students that attended ITT Tech. Now, not included in this $13 billion number is another $6 billion that's expected to be forgiven through a class action lawsuit settlement that I think is supposed to be finalized by November. So that would add a significant amount of more money to this general avenue of borrower defense. There's also forgiveness that can occur through total and permanent disability program. Essentially, if a borrower is able to make a successful claim that they have a disability that prevents them from repaying their student loans, they are also eligible for forgiveness. And the Biden administration has so far forgiven $9 billion through that avenue. So through this week, and these numbers I think are current as of Tuesday, there's been about $32 billion in student loans that have been forgiven through the Biden administration that's not through the income-driven repayment plan program. Now, of course, there's that fifth option, the one we talk about the most, which is this idea of broad-based loan forgiveness. And of course, there's a debate on whether the president could do that or whether that action needs to happen through Congress. We'll talk about where those prospects stand next week. But we really want to talk about not hypothetical loan forgiveness, but the loan forgiveness that's already occurring in our nation. So that's an overview of the loan program. I want to transition into having our conversation about income-driven repayment. But before I bring out our experts from Pew, I want to give you just a little bit of overview about the sort of the trends and the costs of income-driven repayment. So as I mentioned, the federal loan program has been issuing well over $80 billion in loans each year. This is for both undergraduate and graduate borrowers. But income-driven repayment plans have become an increasingly popular way for borrowers to pay back their loans. In fact, actually nearly half of the federal student loan portfolio is made up of loans that are enrolled in one of the four currently available income-driven repayment plans. And the cost of operating these plans has increased considerably for the federal government over the last 10 years. Here's some slides from our friends at the Urban Institute that show the annual costs of the IDR program and how they've increased pretty considerably over the last 10 years. And in fact, the subsidy rate, which I think is very interesting, has increased as well. In other words, that for every dollar that the federal government loans out in income-driven repayment plan dollars, they spend 36 cents through servicing those loans and sort of deferred interest and potential forgiveness. So these programs have become relatively costly. In fact, they become so much so that actually the Government Accountability Office just revised these 25-year estimates for this program. And they thought that the student loan program would net the government $114 billion in revenue over 25 years. They've actually found that it's cost the federal government over $200 billion over this 25-year period. And that's largely been driven by both the cost of the student loan pause, but also the unanticipated cost of income-driven repayment plans, which have, I think, proliferated more than originally intended. Now, looking forward, the Congressional Budget Office projects that this program will cost over $8 billion a year over the next decade. And there's an expectation that the forgiven balances of loans through the income-driven repayment plan program could be north of $20 billion a year. The split there is about $16 billion a year forgiven for graduate debt and about $4 billion for undergraduate debt. And what's interesting about these numbers is it puts the cost of the IDR program on an annual basis on par with what we spend on Pell Grants or need-based financial aid for students. So the cost of this program, I think, could have significant implications for how states and the federal government think about financing college generally, and as well as about policies to keep college affordable for low and middle income students and families. Towards the end of our presentation today, I'll talk about what this might mean for state legislatures more generally, but I want to get into the heart of our conversation today, which is about income-driven repayment and how it relates to loan default and serves as a safety net for students. And to do that, I'd like to welcome in Regan Fitzgerald from the Pew Charitable Trust. She is the manager of their project on student borrower success and has done quite a bit of work on income-driven repayment and student default. So Regan, welcome to NCSL. How are you doing today?
I'm great, Austin. Thanks so much for the time, and I really appreciate the opportunity to talk to state legislators about income-driven repayment. And thanks so much. So thank you to NCSL for hosting this important session about student loans, an issue that's affecting the lives of millions of American families. I appreciate all the legislators who have joined us today to learn more. Many of you have likely heard from your constituents, even though student loan repayment issues are often matters of federal policy. As Austin said, my name is Regan Fitzgerald, and I'm the manager of the Pew Charitable Trust Project on Student Borrower Success. My team does research and advocacy around improving federal student loan repayment, especially for borrowers most at risk of delinquency and default. One area that we focused on is income-driven repayment plans. Next slide. Income-driven repayment plans, known commonly as IDR plans, were first made available to borrowers in 1995. The purpose was to make loan payments more affordable for those enrolled and to help prevent delinquency and default on loans. Over the years, Congress, through the Higher Education Act, and the U.S. Department of Education, through its regulatory authority, have established 4 IDR plans, with the intention of expanding the benefits to more borrowers and addressing the problems borrowers face in repayment, especially borrowers who struggle, such as low-income borrowers and those who do not complete their degree. It should be noted that enrollment in an IDR plan is a prerequisite for qualification for the Public Service Loan Forgiveness Program, or PSLF, which we'll talk more about in the next session with the Department of Education. Today, of the approximately 43 million Americans with federal student loan debt, about 9 million, or 30%, are in an IDR plan. Next slide. Before I go any farther on IDR, I want to touch briefly on default and the consequences when borrowers default on their loans. Unfortunately, of the 43 million Americans who hold student loans, too many experience default. About 20% of current student loan borrowers are in default on their loans. Pew recently fielded a survey of borrowers focused on default. Of these borrowers who had taken out a student loan in the past 20 years, about 35% had experienced default. A borrower defaults on a federal student loan when they have not made a payment for 270 days, or about 9 months. Default can have harsh consequences, ranging from being ineligible for federal student aid, including Pell Grants, to wage garnishment, to the confiscation of tax refunds, to damage to credit scores, to in some cases having professional licenses revoked. It's important to keep in mind that these consequences often hit borrowers who have experienced a range of financial and life challenges. Pew's survey data shows, for example, that borrowers with lower incomes and wealth, as well as borrowers who have a disability or have been divorced, are most likely to experience default. Next slide. So let's talk a bit more about how IDR works. IDR bases a borrower's monthly payment on income and family size. Typically, in an IDR plan, the payment is lower than that available in the 10-year standard plan that borrowers are automatically placed in upon entering repayment. In the standard plan, payments are based solely on the amount borrowed. In IDR, a payment can be as low as $0 a month, and data shows that more than half of borrowers in IDR plans have a $0 monthly payment. Borrowers who still have a balance to repay after 20 to 25 years of qualifying payments, depending on the plan, have that balance forgiven. Borrowers who apply for IDR through their servicer, Every federal student loan borrower is assigned to a servicer, which is a private contractor of the federal government that handles billing and other customer-facing repayment operations. Borrowers in IDR plans must recertify their income and family size information with their servicer each year in order to remain in their plan. Payments can be adjusted up or down based on recertification. Next slide. To give you an idea of some of the major terms of an IDR plan, let's use the most recent and most popular plan, Repay. Repay is available to direct loan borrowers. A borrower's payment is calculated as the difference between the borrower's annual income and 150% of the federal poverty guideline, depending on the family size and state the borrower lives in. The difference is the borrower's discretionary income. If the borrower has a zero or negative discretionary income, their monthly payment is $0. Also, a borrower's monthly payment cannot exceed 10% of their discretionary income in a repay plan. The borrower's spouse's income is included in the calculation, regardless of whether the spouses file taxes jointly or separately. Interest that accumulates during repayment and repay is subsidized in order to limit balance growth. I'm happy to provide a comparison chart that compares the 4 plans for anyone who's interested. Austin?
Well, thanks, Regan. I think we appreciate that summary. Based on your research and analysis, now that we kind of get the broad parameters of income driven repayment, how effective has it been in terms of proving as a safety net for borrowers?
Sure. So I should preface this by saying IDR is not the solution for everyone. For example, some borrowers want and have the ability to pay off their loans in the previously mentioned standard plan, which pays off the full amount of the loan in 10 years. One advantage of the standard plan is limiting the amount of interest that accrues on the loan. IDR plans are an option for borrowers who find their payments unaffordable. Research demonstrates that borrowers in IDR plans have a much lower delinquency and default rate than those in the standard plan, referred to as a fixed payment plan in the chart on this slide. Also, borrowers who have previously defaulted may be less likely to redefault if they enroll in an IDR plan after bringing their loans back into good standing. Unfortunately, data shows us that the lowest income borrowers are often not enrolled in an IDR plan. These borrowers, who are typically at the greatest risk of delinquency and default, are less likely to be enrolled in an IDR plan than moderate income borrowers. As I talked about earlier, too many borrowers are defaulting on their loans even with IDR plans available. IDR is not the panacea for preventing default, but Pew's research has found that reform could help more borrowers, especially low-income borrowers, repay their student loans, and IDR could work better for those who are enrolled. The question is how? Next slide. Our research shows that there are 3 primary ways to reform IDR that would help more borrowers benefit: increasing affordability for low-income borrowers, limiting balance growth, and simplifying enrollment and re-enrollment. Next slide. First, let's talk about affordability. Most borrowers who choose an IDR plan do so because they want or need a lower payment. In a survey Pew commissioned in spring 2021, 61% of those in IDR plans said the need for a lower payment was the most important reason they chose to enroll. But even after doing so, nearly half, or 47%, said of those previously or currently in IDR reported that their monthly payments were still too high. IDR payments are calculated annually. Borrowers who experience fluctuations in income throughout the year have to proactively reach out to their servicer to get their payments changed, which takes time. And other expenses, such as mortgage payments or rent, car loan payments, and childcare expenses are not factored into the payment. In focus groups that we conducted around the country, we heard from borrowers who had struggled to stay on track because they found loan payments unaffordable. For example, a borrower in Kansas City, Missouri told us, they don't consider all of the other stuff. My mortgage payment, my car, you know what I mean. I can never get it lower than as low as what I could afford. And another borrower in Miami said, they act like it's the only bill you have to live. They don't factor in any mortgage, anything. Other research shows us that affordability is a key problem with current IDR plans. A recent study showed that about 1 in 5 Black borrowers were unable to afford food, rent, or healthcare despite being enrolled in an IDR plan. And while delinquency and default rates are lower for borrowers in IDR plans, these events are not completely eliminated. In order to help borrowers most at risk of delinquency and default, such as low-income borrowers, Pew has recommended that any new IDR plan make payments more affordable to help these borrowers get into and stay in repayment. This could include changing the formula that determines how payments are set. For instance, raising the percentage of the federal poverty guideline that's withheld from income-driven repayments. Policymakers could also lower the percentage of the discretionary income borrowers are required to repay each month. Another possible reform is considering borrowers' expenses in the payment calculation. Next slide. Another issue that can prevent borrowers in IDR from successfully repaying their loans is ballooning balance growth. Balance growth is a side effect of IDR. Balance growth for borrowers in IDR plans is most commonly caused by interest accrual. Borrowers who have low monthly payments are often only paying towards the interest that is accumulating on their loans. The principal remains untouched, and the balance can remain the same or even grow as interest not covered by the monthly payment accumulates. It can be very frustrating for borrowers to see no progress towards paying off their loans over many years, even with the prospect of forgiveness after 20 or 25 years. In our research, including in focus groups, borrowers told us that these balances present a negative psychological burden that can discourage repayment. For example, a borrower in Phoenix told us, "I'm never going to pay it off before I die anyways, so what's the point?" A borrower in Miami said, "If I saw that my payments made the principal go down, I'd get excited and keep on paying. But it just keeps adding on to the point where you lose the desire. You just want to focus on things that you really need right now." Keeping borrowers in these plans through encouraging positive actions towards repayment is key. This could include capping the amount of interest that can accrue in order to encourage borrowers to stay in IDR plans that keep them in repayment. Federal policymakers could also explore incremental forgiveness, whether for all borrowers or a subset of at-risk borrowers, such as low-income borrowers. This is where, for example, percentages of the borrower's loan balance are forgiven after set intervals of successful repayment in their IDR plan. It should be noted that the Department of Education is moving forward with eliminating many instances of one factor of balance growth, interest capitalization. Interest capitalization occurs when unpaid interest is added to the principal amount of the borrower's student loan. Capitalization happens following the grace periods and deferments of unsubsidized loans, following forbearances on any loan, and when a borrower exits IDR. Capitalization often falls on borrowers who are struggling to repay their loans. One capitalization event might not add much to a balance, but borrowers who struggle to repay their loans may use several forbearances or pauses in payment to stay out of delinquency when they experience financial hardship or other setbacks. This can pile up. The elimination of interest capitalization for student loans is supported on a bipartisan basis. Next slide. Another major theme that we have seen in our research is borrower concern with the complexity of accessing IDR plans and the need for simplification of these processes. Pew's survey and focus group data shows the lack of assistance and consistent information from servicers, complexity of application process, and the delays in annual recertification of income and family size can all either prevent borrowers from applying or prevent them from being successful in staying in an IDR plan. For example, in last year's survey, 44% of respondents who had ever enrolled in an IDR plan said that the application process was somewhat or very difficult to navigate. Annual re-enrollment can also be a pain point for borrowers. In our focus group in Alexandria, Virginia, a borrower expressed her frustration with the IDR recertification process. Every year, you have to redo your paperwork for every single loan you have. I budget a month and a half where it's going to be screwed up. I call and they go, "Well, it's going to take us time." And then they put me in a forbearance, whether I want it or not. Borrowers who have difficulty enrolling can be discouraged from doing so. And enrollment delays can extend repayment when borrowers are placed in forbearances. One key to helping borrowers enroll and stay enrolled in IDR plans is already on the Department of Education's keychain. In 2019, Congress passed the Future Act, which includes data sharing of income and family size between the department and the IRS. Now we are waiting for the department to unlock that door for borrowers. Another thing that could help borrowers is streamlining the number of plans available, which could reduce the confusion and administrative burden on borrowers and servicers. One effective plan could save a lot of time and stress for borrowers and potentially encourage enrollment in IDR. Austin?
Well, thanks, Reagan. Every time I read about income-driven repayment and think about it, I'm always struck by how complicated it is. And it probably speaks to the fact that I have to read about it all the time, because it's not only a complicated program to understand, but it's also very complicated in implementation. And I think, when we think about student loan forgiveness, this is certainly, I think, the most common path. As you mentioned, 30% of borrowers are in one of these plans. It's the most common path towards forgiveness. At the same time, there are significant hoops to jump through, and it takes place over 20 to 25 years. It's not a particularly easy path, even if it is one that's available to every borrower or borrowers that have meet income qualifications. But given the complications, and you sort of mentioned all the issues with the programs, it seems pretty clear that the program needs some fixes, some simplification. So looking ahead, what could we expect in terms of changes, and specifically, what should state legislators know, state legislators know about this program and changes that might take place?
So next slide, please.
Mhm.
So we're currently waiting for a number of announcements about student loans from the Department of Education, including, as you mentioned earlier, when the current payment pause will end, which of course it's currently scheduled to end on August 31st. Whenever the repayment restarts, the Department of Education must communicate effectively with borrowers so they're prepared, including weighing the best payment option for their needs. For now, the department is allowing borrowers to electronically self-report their income and family size in order to ease enrollment in IDR plans. This is important for the many borrowers whose personal and family economic situations have changed over the last few years. If they choose to enroll in IDR now, before the end of the pause, they do not need to begin repayment before the pause ends, but they may be better prepared for when it does. Towards the goal of improving the repayment system, the Department of Education is expected to release regulations for a new IDR plan in the next few months. We don't yet know the exact details of this plan, but there have been indications that it will emphasize affordability, which, as we've discussed, is a goal of IDR and one that borrowers are concerned about. Pew has encouraged the department to create a plan that works for all borrowers and addresses the many issues that our research and the research of other organizations has indicated as to why borrowers struggle with IDR. A new plan would not be available to borrowers before July 2023. On default, the current pause also applies to collections on defaulted borrowers. So those actions I mentioned earlier, such as wage garnishment, have been suspended since March 2020. The department has announced a fresh start for borrowers who are in default before the pause, moving all of those borrowers back into good standing on their loans when the pause ends. We expect to see more details about how the department will carry out this plan very soon, including timelines for a rollout and steps for defaulted borrowers to take in order to fully benefit from these changes. But it will be important for these borrowers in particular to have support to benefit in order to prevent redefault, which including information about enrolling in IDR plans, if that's the right option for them. Redefault is an unfortunately common occurrence. The Pew survey found that 66% of defaulted borrowers had defaulted more than once. This is a potentially confusing time for student loan borrowers. There's been a lot going on with student loan policy while payments have been paused. It's important for the Department of Education to set up a repayment system so borrowers can be successful, and that the steps for them to be successful are communicated clearly and effectively to all borrowers, and especially those who may struggle to repay. IDR is an important part of helping the system work for borrowers, especially those at risk of delinquency and defaults.
All right. Well, thank you so much, Reagan. We really appreciate you sharing your expertise with us. And I want to give our audience just a second to ask any questions that they might have. But I was just thinking about this, and we did talk about this beforehand, but I do have a question for you. You kind of touched on this. And maybe we could do this together, can you walk through why it would be complicated to restart student loan payments? And some context that I'll give for our audience here is that, we're 2 weeks away from the payment pause presumably ending. In the past 5 times that the pause has been, 5 or 6 times, it's been quite a bit, that it's been extended. The department has usually given notice of that extension fair enough well in advance of that deadline. I think the closest that they'd gotten to an affirmative extension decision announcement was 40 days before the pause was supposed to end. Of course, we're 2 weeks away from that, but they also haven't made any communications to loan servicers about whether or not payments are resumed. So we're kind of in this waiting period where we presume that they'll extend the pause because they haven't taken any other actions otherwise. But if they were to say today, they decided we're going to hold to this deadline and move into repayment, can you talk through some of the complications of actually restarting the student loan program? And it's just simple as, is it simple? And what are some of the complications that might happen there?
Sure. So it's not a simple process. So it, like with any bill that you might receive for any debt that you have, the student loan servicers, who are sort of the borrower's conduit for student loans, have to send out a bill, an actual bill, to borrowers and tell them that they owe that money and communicate with them. It's been more than 2 years since anyone has had to pay a student loan. And so besides the fact that there has to be fair warning to borrowers that they owe on their student loan, providing ample communication that you have this bill that is now once again due, and making sure that borrowers are able to pay that debt on time is a difficult thing. And providing that communication to borrowers, many of whom have gotten out of step in who they're going to be communicating with, is difficult over that period of time. So that's a very key part. Also, a lot of borrowers before the pause were on something called auto debit. So their loans were automatically, the cost of their loans were automatically taken out of their bank accounts. Well, in order to get back into that, you have to affirmatively tell your servicer that you want to get back into auto debit. And so borrowers who might not be aware of that, so there needs to be a lot notice to those borrowers that they need to reapply to that, and not simply assume that their loan will be taken out of their loan payment will be taken out of their bank account again. And then, like I mentioned, there are a lot of borrowers whose economic situation has changed over the past 2 years, whether their family size has increased, they've changed jobs, unfortunately might have lost their job, who might not be able to cover the full cost of their loan payment like they could in the past, who might benefit from an IDR from applying for IDR and having a lower payment. And it takes time to apply for IDR. As I was talking about, these are not easy programs to apply for. You have to provide documentation to your loan servicer. So these are processes that need lead up. And so as much lead up time and good communication that can be provided for borrowers is necessary, should be provided to borrowers, so that we don't have borrowers falling unnecessarily into delinquency.
Thanks. And you might have mentioned this while I was briefly checking the chat, but underscoring these complications are also that student loan servicers have not been doing a lot of student loan servicing over the last few years, and have, as a result, decreased the amount of staff that they're on hand. But now, if they suddenly resume payments overnight, they have to staff up very quickly. And of course, one of the things we saw over the summer, especially in the airline industry, is that when you haven't had staff well trained, you end up having a lot more issues with administration. And of course, student loan program is already very difficult and complicated to service. But if you're bringing in those without experience, there might be additional pain in doing that. And so you'd want to have enough lead up time, not only to prepare the communications, but also to prepare staff to actually carry this out. Because at the end of the day, it's companies that are interacting with borrowers, not the Department of Education. And that is a pretty tricky relationship, and does not always, as we're going to see here in a minute with state legislation, always work out in the benefit of borrowers.
Very true.
Do have one quick question, just from our audience. They would like you to go back and talk about how some of the changes. I think this was in context of the Future Act and the income sharing between the IRS and the Department of Education, how it changes whether or not borrowers need to self-report their income.
So borrowers who opt into, so once the Future Act is implemented, borrowers who can opt into of system where the department, if you file taxes, the department would be able to basically take your income information and your family size from your taxes and plug them into each when you apply, and then each year when you have to recertify.
Well, great. Well, Regan, thank you so much for sharing your expertise with us. This was, as usual, a complicated topic, and really appreciate the work that you all are doing, and we'll be sure to share out your work with when we memorialize this in a blog, and as well as when we send out the recording to everybody. So thanks so much for joining us.
Thanks so much, Austin.
All right, we're going to transition to talking about what's going on in the States. And by the way, there's Regan's contact information if you're interested. And of course, we'll pass around all the resources in Pew, and happy to put you in touch if you have any specific questions of NCSL on the student loan program. Speaking of NCSL, our staff does a fantastic job about tracking student loan legislation in states. And I see from our chat that one of our audience members had a question about, well, are there any suggestions for state level actions? Well, you're about to get the best summary that you could have on that. So we are really glad to be joined by Andrew Smalley, who is a policy associate in our state policy team out in Denver, and he has been diligently tracking state legislation on student loans. So I'd like to welcome him to walk us through these developments. Andrew, welcome, and tell us what's going on in states.
Thanks, Austin. So again, Andrew Smalley with the state policy team here at NCSL. I work on our post-secondary team, and I've been responsible for managing our project on student loan debt over the past several years. So I'm just going to give kind of an overview of what that landscape has looked like and some of the trends that we've been following at the state level. So we've been following all state legislation related to student loans. That's about 500 bills since 2015 in all 50 states, as well as DC and Puerto Rico. Of those 500, about 200 have been enacted into law. We've generally seen the volume of introduced bills go up year over year since we've been tracking it. And we've seen a continued interest in legislative activity this year that I'll touch on in a few slides. So I should note that all these bills I'm talking about today and that we've been following are all available in our database that is publicly available online. I'll be sure to put a link in the chat so you can go through and sort into the categories if you want to look into more detail and read the full text of each bill. So I'll just move into kind of a few of the different categories, starting with student loan forgiveness. On to the next slide, Austin. Thanks. So the first area is student loan forgiveness, which when we talk about student loan forgiveness at the state level, it's a very different conversation than the federal discussions, very different than anything that we've covered in this session so far today. These approaches to loan forgiveness at the state level are generally narrowly targeted programs that are one part loan forgiveness, one part workforce or economic development. So we most commonly see these programs targeting specific workforce professions such as healthcare or education. And then there's programs that also target certain needs such as workforce in a rural area or a certain school demographic or area that they want to emphasize. So I want to stress these programs are not the kind of broad reaching forgiveness that, again, is talked about at the federal level. Many states are appropriating enough money to fund maybe 50 to 100 applicants to receive $2,000 to $5,000 in forgiveness a year. So these are not massive forgiveness programs. They don't generally have the ability to cover all applicants or all people within a state who would qualify for this. So it's much more like a scholarship where a student applies and commits to a time of service, and then they receive the loan forgiveness after completing that service. So we've seen some proposals that would, sort of merge into more of the broader state residency forgiveness, offering forgiveness more generally in return for staying in a state or residing there, agreeing to work there for a certain period of time. But really, there's no major enacted bills that would do that without a direct tie to a workforce profession, such as high tech or the healthcare or education pieces that we talked about. So this is definitely the most common area of legislation that we see. It's a big chunk of the introduced legislation. And it's a big chunk of the enacted bills. About half of the enacted bills that we followed in about 40 states are related to forgiveness. The second piece on the next slide is student loan oversight, which is the second big bucket that we've seen. It's really started to emerge in the past few years. It's broadly been called, in many cases, the Student Borrower Bill of Rights, which started in Connecticut in 2015. Generally, the main elements of that legislation and related legislation here are licensing oversight requirements for student loan servicers, as Austin kind of touched on. Sometimes that can be a tricky relationship where borrowers have a lot of difficulty interacting with their servicers. And so states have, several states have put in requirements under their state consumer lending or banking laws. The other main element of those borrower bill of rights is the creation of student loan ombudsmen or offices within, say, a state attorney general's office that are set up to track and monitor and help borrowers resolve complaints and more generally just interact with their servicers. So about 20 states have put some of those provisions. Some call it formally a borrower's bill of rights, others don't, but have similar provisions such as an ombudsman. We've also seen states, especially recently, enact provisions related to requiring the actual higher education institutions to provide information and disclosures to students about what they're borrowing, what they're agreeing to when they take out these loans in the first place, what their repayment options are going to look like when they graduate, and really just help requiring students and families to understand their options as they borrow. Those have passed in about a dozen states. In terms of the oversight broadly, we really saw this peak in 2019, especially after some chamber flips in the 2018 elections. But it has remained a bipartisan area of action for our members across the country. And we've also seen in the past year or so a real interest in oversight regarding private student loans. Last year, Illinois passed legislation that would require private education lenders to meet some of these additional certifications and information requirements. So that's kind of the oversight piece in a nutshell. On the next slide, there's kind of a few quick categories of bills to go through. In the past year, we followed a lot of states that are limiting how and when an institution can withhold transcripts from students as a debt collection tool. About half of colleges and universities in the country withhold transcripts from students because of owed balance or an outstanding student loan default. So when this happens, that borrowers get in a situation where they've got their credit stranded and they aren't able to use their transcript to, apply for jobs, which can also, make repaying a loan more difficult. The institutions would argue this is a debt collection tool and that they need to use this to get the payment, but a lot of states have expressed interest in reconsidering that approach, given how difficult it is to repay a loan when you don't have the transcript from your education to go get a job to earn financial compensation to repay the loan. And on a related note, the other piece of that we've seen over the past decade is states repealing laws that suspend a professional license if a student borrower is in default on their loan, kind of under the same logic of how are you supposed to pay off your loans if you're unable to use your professional license. So we know about a dozen states have reversed the policy of suspending loans if you're in default on your student loan. And then we've also seen a big area of legislative action around tax credits and deductions for student loan payments or interest. We've seen a lot of bills introduced here and not necessarily a lot that have made it into law. There's proposals to provide borrowers with relief on their state taxes and to give employers tax credits if they make payments on behalf of their employees, but again, not a ton that have actually become law. So lastly, I just want to walk through a few quick bills from the last legislative session. We saw Louisiana pass a version of the Borrower Bill of Rights related to that oversight piece. It was a very bipartisan bill and it was nearly unanimous when it was voted on. And Arizona made modifications and expanded eligibility for their teacher student loan program. And then Washington passed a pretty major piece of legislation that they're going to set up a state-run loan program with low interest rates of about 1% for low-income borrowers and their families. There still seems to be a lot of discussion about how this is going to work and how it's going to be financially sustainable for the state, but definitely something that we've been following and watching. So that's kind of a quick overview of the state actions. Again, happy to answer any questions and share the link to the database so you can all look at any of those bills that you're interested in. I'll turn it back over to you, Austin.
Yeah, thanks so much, Andrew. It's such a thorough review of everything that states are doing. And I have some comments on that here in a second, but I have a question from the audience that might be an all hands on deck question, but I'll take the first stab at it. Sort of a question about public service loan forgiveness as both at the program at the federal level, but I think just generally as a concept, sort of mentioning that there are independent contractors who may work within an independent government and with the government, but they're a private entity, even though they're doing public interest work. So we're kind of wondering whether or not they would qualify for loan forgiveness and whether or not the federal government or state governments are sort of looking into maybe addressing this gap. And from the one thing that I can comment on, I don't know if this is a fully sufficient answer, but the Department of Education within the last month released some new proposed regulations that would expand certain eligibility criteria for public service loan forgiveness. I believe it was on a rather narrow basis, but one of the noted issues is I think that like Texas and California, if you work for a hospital system, you're not technically, even if it's a public entity, you're not technically employed by it, and so you're technically ineligible for public service loan forgiveness. And those regulations created some additional flexibilities for those types of populations, which I think is kind of in line with the question here. So that might be something to pay attention to. There's, I think, certainly the desire on the behalf of this department to make sure that the program is more flexible, although, going forward, whether that flexibility is sustained through policy or future regulations, I think is a little bit in question. But that's the best answer that I have for that. It is a good question. I don't know if Andrew or Regan, if you have any additional insight that you can offer both at the state or the federal level.
The only thing I don't believe there's any bills related to loan forgiveness that I've seen that are related to forgiveness for government contractors, but I'll be happy to check through again and see if there's anything that comes up, but I'm not familiar with any that do that.
All right, thanks. All right, I want to wrap us up a little bit and kind of reflect on some of what Andrew has shared, and it's just to think about student loans and the state and federal relationship. And of course, we're putting on this series because so many NCSL members are student borrowers, and of course, this topic is of major national interest. But from the legislative perspective and from the state federal perspective, I do think that the loan program is starting to shift the parameters of the traditional state and federal partnership in higher education. And I think this is an important dynamic for legislatures to consider. As Andrew just kind of noted, states are starting to assume roles in higher education that have traditionally been considered the federal domain. Oversight of student loan servicers, borrower protection, those are technically states stepping in and trying to fill the gaps with servicing issues and consumer protections from the loan program that the federal government is supposed to be running. In fact, there has been some back and forth between different administrations at the Department of Education that have sort of argued that there's not a state role in student loan oversight. That was the DeVos administration, but the current Biden administration, or the Cardona administration of the Department of Education, has said that states do have a role. So there's been a little bit of back and forth on where states have authority over the federal loan program, and it's an area where they're overlapping. But also in the forgiveness space, even though states are not offering these as generous forgiveness options as the federal government, they also could be considered maybe working in parallel, but also maybe redundant of certain authorities. And so it's very interesting that you see states increasingly taking on things that have been thought to be the federal role. But we've also seen the federal government start to take on an increased role in traditionally what's considered to be, the state's arena. And one of those, of course, is traditional state role is funding of higher education. And this is a slide that was provided for us by Pew this is from 2017, shows you the balance of what the federal government invests in higher education and what states invest in higher education. And on the balance, in terms of direct aid to institutions, states still fund the greater balance of higher education. Most of that's direct funding to institutions, a little bit of that funding, there's some research funding, and then some funding through financial aid. Whereas most of what the federal government's funding is financial aid through the Pell Grant. It's about $26 billion a year, at least right now. And then a lot of the other funding is for research support for institutions. But what's not factored into this chart is the cost of the loan program. And as we mentioned, this was from 2017. So I think back then, annual loans were probably north of $90 billion. So just the amount of loans that the federal government was using to finance the higher education system is greater than state investment. And of course, if you look at a lot of the subsidies that we're seeing through various forgiveness options, that's sort of driving up the cost of federal subsidies for higher education. And so, in the past, it's mostly a state share financing higher education, but that balance has really shifted to where it's either an equal relationship or starting to become one that favors the federal government, at least in terms of annual appropriations. And one of the consequences of that is that the more that the federal government is on the line for funding higher education, the more they're interested in potentially exploring accountability options to ensure that schools and institutions are providing a quality education and serving their students well. And that's something that's typically been considered a state authority or sort of a shared state-federal authority, but it's certainly one in which the federal government is looking to increase its role. And so this is a dynamic that NCSL is paying attention to and that we'll be discussing and trying to figure out what that right balance between state and federal authority is on higher education. And of course, I think in broad terms, the federal loan program is potentially a prism through which we see, the problems of our own higher education system. We know that there are a lot of students that graduate, and some of them and many of them have a credential of value. They have manageable debt. But we also know that millions of borrowers struggle to pay their loans. And I think Regan's presentation and the work that Pew has done really shows that the default on loans is not an uncommon experience. And even if students don't default on their loans, there are many that take on debt but never receive a credential and struggle in repayment. There are some that receive a credential but find that it might not have any value in the labor market and thus struggle with repayment. And then others may take on too much debt but still get some credential, a degree that's worthwhile, but maybe the cost was something that their employment could never keep up with. I think that's some of what's driving the costs in the public service loan forgiveness program. And as we mentioned earlier, we're starting to near a world where the federal government is forgiving as much debt as it's actually giving out in financial aid each year, which may be the dynamic that federal policymakers are looking for, but it does strike me as a curious dynamic. And so the thing that I'd like to leave you off is, as the actions for loan forgiveness continue and even increase, I think that's going to have implications for how our country, at both the state and the federal level, really thinks about how we finance and even govern higher education. And so we're going to get into that a little more next week with the department when they come in. But I want to preview that real quick. So yes, next week at next Wednesday, same time, same place, August 24th, we're going to be joined by senior officials from the U.S. Department of Education's Federal Student Aid Office. It'd be Ashley Harrington, who's a senior advisor over there. She's going to come talk to us about the public service loan forgiveness waivers the department's been rolling out. Also going to talk about the actions the department's taken on borrower defense and total and permanent disability forgiveness. And if there's any news to share over the next couple of weeks, we hope that they'll be the ones to break it to NCSL, but if not, I'll also give you the latest on the student loan pause, broad-based loan forgiveness, and whether or not there's a new expanded income-driven repayment plan out there. So much is going on. I think that's been underscored by our time today, and there's so much yet to cover. But I really appreciate you all joining us today. Again, I want to thank Regan from Pew for joining us and Andrew from NCSL for sharing their expertise. And we look forward to seeing you all next week. So until then, take care.